Good afternoon, everybody. This is Peter Mullen. I'm going to be starting in about a minute, so please stay tuned. We'll get started. We'll get going in about 1 minute. So thank you very much. Good afternoon to everybody. My name is Peter Mullen, and I welcome you to our webinar today that we have from American Consumer Credit Counseling. Maddie, I just want to do a quick check that I'm coming through okay?
Yep, you're coming through just fine.
Okay, great. So welcome to everybody on our session today. This is like about, I think, our 8th or 9th that we've done. We do 2 of these every month, just as an FYI to you. Again, my name is Peter Mullen. I'm a counselor, and I work at a nonprofit in the Boston area. And our job is to provide free financial literacy, free financial education, counseling. We've been doing this since about 1991, so we're coming up actually on our 30th year. So I welcome you to our session today. We've helped many consumers across, not just Massachusetts where I am, but really all over the nation. We have licenses in every state, and we help people in all different ways and shapes and forms. For today's session, it's all about the home buying process. And again, just so for those that are new to this, if you're a first time with me, we will keep you in a listen-only mode, but I will encourage a couple times throughout our session today, based on how timing goes and everything, I certainly encourage your participation through your questions. And the way we'll do that is when I simply ask out, are there any questions, or I pose a question to you, that will open up the dialogue on your side. And my colleague, Maddie, will help me to kind of deal with the questions or the comments that are coming in. And then we will do the best to make it interactive that way. So I'll cover some material and then open it up to you. Thank you all for all the questions and comments you made in the registration process. I have maybe about 20 good questions that you have, so I may go with some of those as if there's a silence on your end. I hope there's not. We have folks today from about 14 states, so I welcome you all to us. And I want to give a quick plug just for the future. June 24th, a couple weeks from now, we'll be doing another session at 11 a.m. Eastern Time on retirement planning. Coming up in July, we have a couple on what we're calling transition. In other words, how to deal with finances and foreclosure, how to deal with your finances and divorce. I hope that's not anybody's issue, but if it is, it's good to have some thoughts on how to deal with it. After our webinar today, you'll receive an email from Maddie that basically gives you a copy of this PowerPoint deck, a link to our webinar in case you want to watch this multiple times, and then an evaluation to please tell us what you think. We would love to hear from you. So let's get started with our session today. Okay, the goals that we have are pretty simple. And the simple goal is to review and explain the essential components of preparing for, purchasing, and maintaining a house. So one of the things that I have in my past before I started working at ACCC was I was a first-time home buying counselor and used to run a program here in the Boston area. And one proud thing I'm glad to say was one year we had 600 students over the course of the year, and 1/3, 200 of them bought houses. So not that I can claim a one-to-one credit for that, but we are certainly part of the process of knowing what it is to buy a house. Our agenda is to start just like a house. We want to start with the foundation. And so for us, it's buying a house is a big thing, right? You all know that. So it's all about planning. It's about managing your money. It's about understanding and preparing for what a house requires. So I give an analogy that buying a house is almost like having a baby in a way, because when you have a baby and it demands diapers or it demands food, you gotta take care of it. So houses demand a lot too. So please be sure that you're ready, willing, and able to go. You need to understand your options. There's lots of options when you go to buy a house, and that's both good and challenging. You have to decide many things. We'll give you some of those thoughts today. You obviously have to protect yourself. This is a big investment, so there's ways that you have to understand what the protections are and certainly take care of them. Work with the appropriate people to make that happen. And I'll end with what I'm calling a typical 12-step journey to put it all back into a timeline as to what you might deal with time-wise, what you'll deal with money-wise, and what you'll deal with task-wise. There's lots to do to buy a house. So let's get started. Did I have a question right from the beginning there, Maddie, or are we good to go? No? All right, then let's get started with this whole process. So the starting point for any house is the foundation, and then the body of the house, and then the roof. And that's really the three things I'm going to cover today. So for me, again, the foundation is the starting point of thinking of what are the key things you need to know. And a lot of that is money. I hate to say it, but the foundation of building your house is getting a lot of your financial bricks in order to be able to support what you're trying to do. There's lots of things you need to do, but a foundation of having a good financial footing is very important. What comes next is taking care of a lot of business, which we'll cover, of what I'm calling your housing choices. That's such as who do you work with? Where do you buy your house? What are some of the choices you have in what you pick for a house? And then, of course, I want to make sure you end with the protections that you have. And understand that buying a house, as you know, is a huge investment, and you need to do a lot of things to protect what you have. And some things are mandatory, and some things are your choice. And I hope that you'll hear what some of the pros and cons are before you make some of the decisions that you make. And I will cover some of those. And then I'll open it up for questions, like I said, at various points, and answer some of the questions you guys brought up during your registration. Okay, so let me first go through some of the parts of the foundation. We're going to start at the bottom, work our way up. So from a foundational point of view, there's 5 things I want to cover with you. There's lots of things, but there's 5 main things I want to cover and start with the kind of the most basic. The first thing you need to have, and you all need to be dealing with, is obviously savings and the finances, like I said. People ask such things as how much should I save? How much should I have for a down payment? One of the questions somebody asked, some people ask, can I do a 0 down payment? Or should I put down more than 20? These are all questions that really I don't have an answer for. There's pros and cons on either side. There's positive things or negative things according to what you decide to do. Advantages and disadvantages. I can just tell you some of them. First, when you buy a house, obviously the more savings you have is the better, because there's so many demands on your money. I've listed just basically like 5 of them, and that is, or 4 of them here. The offer. To when you start in the process of looking for houses, the very first money you plunk down is typically around $1,000 to secure the house. You're looking around, you work with a broker, you finally say, this is the house I want. When you make a commitment, you have to put down an offer of $1,000. That seals the deal and starts you on the pathway now toward many things you have to do to get that house. You have to listen and follow the rules from that point on too. You want to get your offer back if the house falls through, so you got to play by the rules. Down payments come if after you've gotten to a point where you now really do want the house, the offer has been accepted by the seller, you've now negotiated further. To make even a further commitment, you put down a down payment. Now, this is where you put down anything from 1% in the case of a veteran's loan. They could put down 0%, beyond their offer. They could put down nothing. But what you can put down is as much as 20%, 30%, 50%. It's up to you. The more you put down, the smaller your payment will be month to month. Also, when you hit that magic number of 20%, typically your interest rates are lower. You are a less of a risk to a bank. So there's advantages in putting down 20%. But at the same time, for those that might be moving soon, maybe you don't want to commit that money right now. So you have to think about your own situation. Closing costs are come at the end, and that usually is anywhere from 6 to 8 to 10 weeks from the time you've put down your offer. You will be closing in maybe 2 months. It depends on how everybody works together. And then again, what do you need? Anywhere from 2 to 5% of the amount of your mortgage is what is estimated. Let me put it another way. $3,000 to $5,000, depending on how you're doing your closing. You can either pay it separately or include it overall in your mortgage. There's different ways to do that. And then finally, don't forget moving. You would generally have to move from where you are to where you want to go. That again costs something locally, whatever that is in your town, $1,000, I'm guessing. So you can begin to add the numbers, and we're going to show you some numbers a little bit later as to how this might work. Next thing is budgeting, and I can't emphasize this enough for folks, is that a lot of people don't like to think about budgeting, but it is really one of the most important parts of getting ready to buy a house. Very simply put, you need to know what you make, you need to know what you spend, and you need to know what available monies are left over for you to dedicate toward a payment. That payment is affectionately known as pity, and it is a pitiful time sometimes when all the money goes out. Pity is your principal, interest, taxes, and insurance. Those are the 4 known things. You may have more. We'll talk about that. And those amounts are going to differ according to your situation. But you need to know, and your mortgage broker needs to know this too. How much do you make? How long have you been making it? How long you've been employed? They're not, someone asked in the initial questions, can I buy a house if I don't have a job or if I don't have a full-time job? I would say to you, it's probably not very likely, because they want to ensure that you have the funds to pay them back. Lenders are only lending you money not because they want you to have a house. They're lending you money because they want their money back with interest. That's why they lend it to you. They don't want to own the house. They want you to own the house and pay them. So certainly money decisions are all made through you having this well documented. I would say to anyone on the line, if you haven't started saving or budgeting now, by all means get to doing it, because those are things you will never stop doing, and they only help you. The third thing is your credit profile. Again, you've probably heard a lot about this. Obviously, the way that works, and I have other sessions we've done on credit, but the highlights of this is simply, very simply put, the higher your score, and the range is anywhere from 300 to 850, the higher the score, in other words, I'm talking in the 700s, is your typical amount. Now, can some people start at 680? Yes. Can some people start at 620 for a score? Yes. It depends on the mortgage you go for. So an example being a loan which some people asked about, like an FHA loan, that's a Federal Housing Authority loan, will allow people to start at a lower score. But what that means for you is it doesn't mean that you necessarily have a lower interest rate. Generally speaking, they offset the risk of a lower credit score by charging you more on the interest side or other fees. So again, your advantage, what you all should be doing now, if you're looking to buy a house in the future, be doing the right things to get your scores up. Don't be closing off credit cards. Don't be buying expensive cars right now. Try to get your score higher and try to have it so you have less interest. Let me cover two more things, and then I'm going to open it up to your questions. Borrowing. Now, obviously, on point number one, whatever you have not saved or have not been given as a gift from your family or friends or however else you might have money in savings, you have to borrow the rest. Now, there's two levels out here. There's what's, at least that's here in Massachusetts. I think it's pretty much the same around the country. We often use the terms pre-qualification versus pre-approval. Pre-qualification is, think of it as an informal discussion you may have with a mortgage broker or a banker or a mortgage company that says, look, this is the highlights of what I make. This is the highlight of the debt I have and the expenses I have. Do you think I would qualify for a house? And they would talk to you back and forth, what size house, what amount, and so on. And then from an informal point of view, they may say, yes, you do, or no, you don't, you need more money. To move that to an official estimate and an official yes or no, you actually have to apply. And then you could get what's called a pre-approval, where the bank makes you a commitment, like a more of a formal verification, and they would now then pull your credit, check your jobs, check everything about you, your shoe size, I mean, everything you've ever done, your credit report for the last 2 years, your banking statements. They want to know when money has come to you. They're going to question if all of a sudden $50,000 showed up a week ago. It's not that that's wrong, but they're going to question where it came from. So banks are in the process of trying to get rid of their risk and trying to know everything they can about you, because before they commit $200,000, $300,000, $400,000, they want to make sure that you're in great shape to pay them back. I mean, that's the whole thing right there. If you're in great shape to do that, they'll lend it to you. If not, they will either charge you more money or say no. The last thing I want to cover in terms of this initial foundation is being maintenance ready. Now, people often don't think about this, but I want you to think about it because I know it's part of it. I've been a homeowner myself for 30-something years, and I would just say this to everybody who's thinking about a house. You got to also think seriously about what it means to go from renting, which has its pros and cons. The landlord takes care of everything for you, but you don't have equity. You don't gain equity from a landlord, but they take care of everything for you. So look at this little array of things that a typical homeowner has to take care of and should take care of. You have to be ready to do all these things: shoveling, raking, replacing screens, tiling, taking care of windows. You can't call anybody else in the night unless you want to pay a vendor to take care of this. If you have water that's leaking somewhere, you got to take care of that. Fixing a wall, replacing an outlet, you can call somebody, but if again, I would suggest folks take a small, do-it-yourself course from your local high school, because knowing how to fix an outlet on your own for $10 is far better than hiring an electrician who comes in at $100 per hour. Fixing a wall, fixing a hole. And let me just tell you right up front, getting water out of your house is one of the number one things you've got to do. Make sure your drainage is good on the outside. Make sure there's no leaks on the inside, because moisture leads to mold, which leads to many other things. So you got to be ready that these things happen. Painting inside and out, insulating where possible, fixing small leaks, I already said, and then doing things like simple things, but they mean a lot. Changing your filters once a year, changing the batteries on your fire apparatus or whatever, cleaning the gutters. I've seen so many commercials on these. They're not as bad as they make them out to be. But if you do have leaves like we have here in New England, you got to make sure that the water flows away from your house. And that's a big thing, okay? So these are just some ideas of how you manage the 5 top things. I'll have more, So Maddie, let me ask if there's questions that people have for me right now. Okay, I see a few questions. Will we get the slides and recordings afterwards? Yes, you will, Maddie said. What about the 60-day timing from the last slide? I missed that. Okay, what I think that was saying was typically once you get a pre-approval, and it depends on your bank or your mortgage company, they will commit the pre-approval for a period of time. I can't make a lot of statements here today that says this is the way it is in your town, your city. We have 14 states online here. Not every state does everything the same. Wouldn't the condo solve this maintenance issue? Yes, in most cases. Yes, you're getting a hybrid. I'm talking about houses now today. I'm talking about single houses. So yes, a lot of this applies to a condo, but in maintenance, you have to get insurance from what they call the walls in, and you're responsible for that. So yes, but you have to pay something else, just mentioning, condo fees that you don't have to pay for a house. So like anything else, you're right. There's pros and cons of a condo, and there's some positive and negative things there. So yes, that's exactly right. And you make that decision when you buy a house. Let me move on to some other things for right now, and just tell you a couple other things before I get into some further. Again, I will get to your questions as best I can. So I just want to go back for 1 second to this screen about the savings and the money. I just wanted to add beyond that, these 4 things, don't forget there's furniture, appliances, immediate repairs. You really need to be thinking of the full gamut, and I would say to anybody on the line, add all this up, really do the thinking. And if this gets you to think about delaying the buying of a house, by all means, that's a good thing. You should never buy a house before you're ready, or else you're going to be buried. The second thing I'll tell you here, which is a good thing to know, and this is a positive thing, for those that can do the budgeting, and number 2, here's something that some of you may have heard. If you can do your payments for your mortgage, the PITI, which we're going to show some examples later, and you can pay it half of your PITI, meaning you pay, if you had to pay $2,000 for that, instead of paying $2,000 once a month, you paid $1,000 twice a month. You do save some money, right? It's because you're paying a little bit ahead, but not as much as if you pay every 2 weeks. If you paid $1,000 every 2 weeks, which is almost half a month, you'll end up paying your year's mortgage in 48 weeks, and you'll actually pay 1 extra payment per year. So I hope that all makes sense. In the end, your 30-year mortgage, you'd cut 5 years off your mortgage. So let's move on to some further questions if you might have them. Maddie, are there other questions that people have at this point? Let me just see if I see any. Okay. So far, no other ones. Okay, great. So let's move on to some other topics here within our session today. All right, lot to cover, have only so much time. All right, more the merrier. We're still on the foundation here. Let's talk some numbers. Again, high level here, and I'm showing you the example on the right of a $400,000 house, right? So that's my sample on the right. $400,000 house, 3% interest, 30-year mortgage. If you pay taxes, again, typical, this depends on where you live, $3,600 a year to make it nice and even. That would be, what's that, $300 a month. And then your insurance for this is $100 a month. Again, these are just numbers for us to go by. So what you would pay in your initial monies to get this house going is you'd offer them the initial $1,000. You would offer them a down payment. If your offer was accepted, you have to start talking down payments. And now here's where you make a choice. Do I offer them 5%, 3%? According to the mortgage you get, some mortgages allow you, like an FHA, allow you to put down as little as 3.5%. Some mortgages allow as little as 3%. Some mortgages, they want you to put down 20%. So you got to know what your mortgage is and then what it's going to cost you. So in the example of a $400,000 house, a 20% down payment is $80,000. If you can't come up with that, then you got to figure out either wait or just take the pros and cons of doing it now. Closing costs are usually 2 to 5% of your cost. Again, I can't tell you exactly, but I would guesstimate anywhere from 5 to 8 or something in that realm to 20,000. It depends on many things, because in your closing costs are many things about settling up with the seller. If there's oil in the oil tank, if that's what you have to pay up that difference. You have a lot of legal costs. You have to pay for it, both the lawyer and the cost of pulling up the loan. There's all kinds of costs that are there. Now, again, in most cases, you can roll all this into the overall mortgage if the bank will let you. Moving costs, again, let's just say $2,000. So you can begin to do the numbers. Let's look at some things here with paying a down payment of less than $20,000 and a down payment of $20,000. So I want to show you the difference. If you did a 5% down payment on this $400,000 house, your principal and interest would cost $1,602. Your taxes are $300, which I said was $3,600 a year. Your insurance is $100. And then for those under a 20% down payment, you have to pay this, I don't like it, but it is a reality, this thing called PMI, or private mortgage insurance. Your lender is the one who's taken all the risk. So they want to mitigate their risk by ensuring you cover their risk for them. So you have to pay for the mortgage insurance that if you ever lost your job or couldn't pay the money back, the P&I, they will basically, find a way to get that covered. So you can see that this person here pays $21.60 a month, and in the first year, they're paying in interest, I calculated this, $11,291. That's the first year of this example. So I'll tell you some good news in a second. Let's go on to the second one. In this scenario, someone pays 20% down payment, so therefore they're borrowing. Think of it: if you take 20% and they put down 80,000, they're borrowing basically 320,000. Their principal and interest is smaller than, it's $1349, the same taxes, same insurance, but no PMI because they're over the magic 20% level. Their overall monthly payment is $1749. Their first year's interest is $9508. So here's where maybe some good news for some of you comes in. On the left side, the mortgage, the interest you pay is deductible. It's tax deductible, and PMI is tax deductible. So I did the quick math. The PMI in the first year would be $1,896. And if you add that to the $11,291, you come up with over $13,000 in deductible interest. So this is one of the reasons why people love the tax deduction on houses. You end up having to send out a lot of money, but the good news at tax time, you get a good amount of it back. So that's like anything else I've said today. That's some of the pros and the cons. You have to decide what works for you and if you're ready. So let me give you some other things to think about. Budgeting. People have asked me in the initial questions, and so some of this I'll cover right here. They asked me about, how do you know if you can afford a house or not? It's really the other way around. How can you know if a lender will even qualify me for a house? Because they do everything by what's called ratios. So there's two kinds of ratios out there. There's what's called a front-end ratio, and that means simply taking your full amount of your housing costs, and in my example, I gave you $1,749, and you look at your gross income. Now, it's interesting. This isn't your net income. It's your gross income. So in this example, I'm pretending you make, or I make, $60,000 a year. That means your gross is $5,000 per month. I hope the numbers all make sense to people. So if you back your way into this, or you can see that this is around 35%. Now again, let me caution you. I'm giving you just an average. Some banks may look for a lower front end ratio. So what this means to you is, if you have, your housing cost is much higher, and this was in fact, your housing cost was $2,500, that would be 50%. They would never lend you the money if you had a 50% front end ratio. Hope that makes sense. I think the numbers all work there. So you can begin to work your way and find, and there's all kinds of great mortgage calculators, by the way, that tell you this as well. Okay, so please, by all means, go to the sites. I have some things at the end that will give you some great references. There's another ratio out there called the back end ratio. Again, those in the business know these. This is where they look at all your current loan debts that you have and they put it over your gross income. So I can tell you right now, looking at the 5,000, looking at the 45%, again, this is just an average, it's probably less, maybe less in your city, is saying in so many words, you can look at the difference between the 1749 and the 2250. It means that I could have no more than 500 other debts per month. So think of all your student loans, what you're paying on your car, what you're paying on any credit cards. All that combined can't add up to more than 500 more, as this example shows. You can't have, greater than 40 or 45% of your money eaten up on all these debts, because people do have to live. You have to live and eat and pay for other things beyond housing. So, the thing I see in the industry, and I've been in this industry for a good number of years now, you need to realize that people are getting closer and closer to 50% of their income. What that means is their house, they're really stretching themselves too thin, because it's then really hard to deal with any issues that come up in life, challenges, the car goes, or the car tire blows, or your water heater blows. You need extra money to take care of other issues. So you can see that you can play with the numbers and start to figure out, can I or can't I afford it? Based on these ratios, this is what banks go by, and this is how they tell if you can do things or not. Are there questions coming through now, Maddie, or anything else coming? Or I'll answer a couple questions from folks. Okay, no other questions. So let me throw out a couple that people had. One was resources for first-time home buyers. Let me tell you, by all means, look for what's called a first-time home buying course in your particular city or state. They're offered all over America. And what they do is what I used to do, like I said, in my prior job, which is they would generally provide you with a HUD certified course that lasts 8 or 9 hours, depends on your city. It covers everything you need to know that I'm covering, but in much more depth. And it talks to you all about the home buying process. And for taking that course, which costs anywhere from 30 to $100, at least in my area, it's not much. Then they give you a certificate that allows you to buy into certain local mortgages, and some of those only demand 3% down payment. So again, by getting to know it better, learn better, it's an inexpensive way to get into the market. And then you might find that it's something, hey, you start out small. This is what I recommend. Buy a small house, maybe a ranch, and then start small. And then 2 years from now, sell it and use the equity in it to help you buy your next house. Someone asked, what is a good debt to income ratio? I just covered that. Your ratios, they want them to be 40% or less. That's what it's ideal. Never over 50, never acceptable. Do you have to have a full-time job? I told you before, pretty much yes. You have to have a good income flow, absolutely. How much should I save for a down payment and closing costs? Again, I already covered that. You have to basically have as much as you can. Depends on whether you're going for 5% down payment or 20% down payment. Obviously, the more, the merrier. Okay, let's go into some more housing choices now. And again, I'll open it up to questions and other things you might have. That one of the most important things I would advise you to think about beyond the money now, this is now housing choices. This is the second part of everything. You got to assemble your team. And one of the most critical parts you need to do right from the get-go is find a good realtor, a good real estate agent. They're either a realtor or a real estate agent according to what level of education they have. But they are your primary advocate. And here's one great piece of news if you don't know it. They are free. A buyer's agent is free. They're paid for by the seller when they get the commission on the other side. So basically, you could have a buyer's agent who works with you. I would make sure you trust them, you know them, they know your area. That's the key person. And then it's possible for them to work with you for 4 months, 5 months, and then you don't buy. it's possible for them to have done 4 months of work and get zero. That's the game, unfortunately. The realtor is also very good. If you trust them, then they will be very good to help direct you to other people you should know in the neighborhood. I'm calling them your village people, because it takes a village to help you buy a house. You need a good mortgage lender or banker, a very good lawyer. The bank that you borrow the money from has their lawyer, but you need to think seriously about whether you should get your own lawyer too. Again, I would just tell you that generally, at least where I am, it's often a good thing to do. You need an inspector, because at the point that you provide the offer and then they accept your offer, your next step is to have a house inspected by a professional inspector to see if you're getting a good house or one with all kinds of problems and holes and pests and mice and all kinds of termites and all that. You need to know that and know what it is you're buying. You have to get insurance if you are borrowing from a bank, you have no choice. You have to get insurance because it's not your house. It's their house. Until you pay the last dollar off, it's not your house. So you need to pay for an insurance, which again, I wrote before, it's maybe $100 a month. It depends on, again, the percentage of your value of your house. And then town hall. Why town hall? Because town hall is going to help you know what happened to your house before you bought it. Did they take out various permits? What were the costs of the house? What happened to the house? Anything about, if you start to think about what would it cost me to fix this or that, a town hall can help you. An inspector will generally not, if they're worth their salt, they will not tell you. So underline that. They will not tell you how much does it cost to fix the roof, how much does it cost to fix the sill or to replace a window. That's not their job. And if you ask them if they're ethical, they should not be telling you the cost of things. It's a separate conflict of interest if they do that. The next thing to think about, of course, is location. You can't change your location, but location is very, very critical. And I'm going to give you an example in a second. But obviously, that rules most everything. Obviously, the school system, the water you drink, the environment that you're in, if you're near high water level, all that's determined. The value of your house, everything is determined by location. You can't change that. And in some cases, as some of you may know, people will pick the location and ignore the house, rip it down and start again. It all depends on your situation, but that's a very realistic thing that happens sometimes. The ground that you're on and its location and what it views, like the water or somewhere near a resort or something, that is often much more valuable than the house itself. Houses can change. Your mission in terms of checking things out is to check out what they call the comps. And the comps are simply other houses that sold within the last 6 months in the area that you're looking. This is what a real estate agent is going to do. That's what they do for you, but you should look too. Find out what their comps are. And it's really important for you to know, what they are in your area. And then you'll be more informed as to what things are going for, what you should be paying for your house, the questions to ask about the water table. If you see all the houses around you are flooding, the chances are your house floods too, in spite of what they say. Just one note, that good news for people, just to say to you too, if you are in the business of now looking for a house and you're really serious, here's an important note for you all. People worry a lot about your credit scores and your credit reports, right? Remember, another seminar I talked about what's called hard hits. Every time you apply for a mortgage, I go to mortgage lender A for a mortgage, that's a hard hit on your credit. If I go to 5 different lenders, but I do it all within a 2 to 6 week period, please check your local town. That counts as only 1 hit on my credit. So let me say that again. I go to 6 different lenders, do 6 different applications, if that's what I did, but I do it within a short period of time. It only counts as 1 hit, not 6 hits on my credit report. The third thing to talk about is just this, another tip for folks. In your consideration, you want to think about, should I buy brand new? Should I buy vintage? That's another euphemism for, is it old? Here where I am, it's not untypical to have houses that are 80, 100, 120 years old. But I know with some of the folks on the line here, I see some of the places that are coming from, Florida, Connecticut, Illinois, Utah, New York, New Jersey, New Mexico, Pennsylvania. Yes, some of you have houses older than us, some of you don't. So you got to determine if you're looking for brand new, which generally speaking, things are cleaner, straighter, 90 degrees, they're plumb, that's a good thing. But just because they're new doesn't mean you don't have issues. Sometimes they're built with cheaper materials. Sometimes things are built wrong. I've heard of stories from inspectors who say they forgot to put the pipes together in a new house. So you turn on the faucet and there's no pipes under the sink. Those things happen. That's why you have an inspector. As a general rule around here and where you are, generally speaking, older is cheaper. It generally is larger, generally has more character, but generally is more work for you because things are out of square. Maybe it has termites. Maybe the floors go at a slight angle. Every time you walk them, you put a marble on the floor and the marble rolls toward the wall. That's not necessarily a great sign. So are there some questions now? Okay, I think there are some. Someone said, we got a question asking what you meant exactly by a short period of time when applying for multiple loans. Okay, I think I answered that. 2 to 6 weeks. And I believe it differs based on areas. So you want to find that out. So if you're going to get in the business of applying for a loan, just to be clear, do them all in a batch. Now, most people don't apply for 4 or 5 loans, but I'm saying if you do them all together as a same thing with cars, by the way. If you're in car shopping, just the same concept. Within 2 weeks, if you're looking for car dealer A, car dealer B, and car dealer C, and you apply for each one of them to buy a car, you do them all within 2 weeks, it counts as one hit. All right, let's move on. I have a little test for people. I'm going to ask this. So I'm going to ask a question to everybody. Hopefully I have this right here. Yeah. What do you think the cost in Boston is? So I'm going to throw that out to you and let me explain. I thought this was an interesting example for folks. So I'd like you to sign on and give some numbers for Maddie, and Maddie can pass them on to me. So look at the left-hand example, Bowling Green, Kentucky. I just picked that out of something middle of the country. It costs about $122 per square foot to buy that house. It's about $250,000. This is roughly speaking, right? I don't know where it's located. I don't know what it looks at, but I'm giving you a rough thing. Going by new construction at $122 per square feet. Would people make a guesstimate, just to kind of have a little bit of fun here for a second, and please feel sorry for me, about that house on the right, which is identical, but comes in Boston? So what do people think? Write back and tell me what you think that what that amount is. 400,000, I see. 600,000. Okay, give me a couple more. What do you think? Any others? 550. Keep going, higher. I need a little bit higher. So I'll take 1 or 2 more, and then we'll go with it. Okay, 950,000, 600,000. Okay, that's good. Let me give you the answer. The answer is $760 per square foot in Boston. That would cost about $1.5 million. And again, I know it depends on where it is in Boston, but I'm going by the square foot cost, which is over 6 times as much. So location makes a huge difference, you know that, but I wanted you to understand it depends a lot on where you live. Let's end up our focus on protections. Very important for you to know the protections here, okay? And we'll answer some more questions in a minute. The most important things I can tell you is this. You gotta have an inspection. In today's competitive world, because there's less inventory, I am totally freaked out that more and more people in the world, in the United States, are walking away and not having an inspection. But a professional inspection follows the offer. After you make your $1,000 offer, you basically want to know the condition of the house. You want to know how detailed it is. It's all in writing. A professional inspector never tells you what you should do. They're supposed to be objective professionals who tell you this is what is a problem. This is a major problem. This is a minor problem. And you should never walk away and say, I will waive the inspection and so on. You should use that as a way to negotiate your price, or what they call contingencies. And contingencies is a legal name for, I will buy the house with the contingency that the seller will replace the roof, as an example, or the seller will get rid of the termites on the west side of the house. If you have the right to have that in there, and if they say no, then you absolutely should just use your feet and walk away, unless that's what you want. I mean, it's up to you. But if I think of it this way, how many people on the line would go to a parking lot, think of it, a parking lot, and say, I want that blue car over there, just sell it to me? Most people don't do that. They take the car for a ride, they check it out, they open the engine, they kick the tires. That's what you do, and you should certainly do it with a house that costs 20 times as much as a car. Insurance, another big thing that you need to know is that you have to have insurance. If you have a mortgage, you have no choice. If you're a full owner, it's up to you. I mean, of course, I recommend house insurance, because if your house burns, you want it replaced. Understand that when you buy insurance, you're insuring the house, not the land. For the most part, unless there's a nuclear explosion, your house is the part that can burn. Your house is the part that can get wrecked or hit by a storm or a tornado. So you buy coverage for the house, and you schedule, according to your insurance dealer, you schedule other items in there. Jewelry, your furs, your Renoir and your Picassos that you have to be scheduled, or else they will not be covered. And so you work out what it is for you and the insurance. Again, here's another example. The higher your credit score, the lower the amount you pay for insurance. They consider you a less of a risk. If you have an 800 credit score, they assume that you're also good with managing a house. It may or may not be true. Let me cover one more item, and then I see some questions coming through. The last thing I would point out to you is how critical a real estate lawyer is. And understand, here's a key thing I learned in my first time home buying classes I did. Get a real estate lawyer, not just any lawyer, not your brother-in-law who handles divorces. You need someone who knows real estate law, because it's very complex and convoluted. So you first want to start with a real estate lawyer. You can go with the bank's lawyer, and they are supposed to cover you, but that's a hard thing to demand much out of the bank's lawyer. They will have their lawyer. I recommend, and it's up to you, that you get your own, because there's so many things for you to deal with. It's too many challenges. What the lawyers do, they draft the offer, you pay the $1,000, they draft what's called the purchase and sales. That's where all the contingencies go in. So if you had things in there, it all has to be in writing. If you had in there that the chandelier stays, the washer and dryer stays, the seller will take care of the roof, the seller will take care of the stairway that's half broken. That's all written in the purchase and sales. And if it's not written in there, it's not going to happen. So you want everything in writing. And then at the very end of the process, there's what's called the truth in lending, TIL, closing docs. So if you've gotten to that point and they set a date for the closing, by all means, pay attention to the dates. You can't lose these things. Once you'll see in my timeline, once the timeline starts, everything's on a clock. Money talks and money walks. So you gotta, if they say the closing is July 1st, you don't go on vacation that week. You gotta be here on July 1st, because that's when they're closing, and that's when you swap money. You need to conduct a walkthrough. A walkthrough is very important for you to do. That's another way you save yourself, which simply means if your closing is on July 1st, they typically will have that scheduled either the day before or the day of. It's your last chance to see the house with nothing in it. The seller's clothes is gone, their furniture is gone, everything's out. Now you can see the floors and the walls and see if there's any holes in them or stains or whatever. You can come back to the closing and say, I want this taken care of before I close. Again, you negotiate. And then a very important last thing to say here is the fair housing laws. I hate to say this, but I'm very well aware of it. The fair housing laws are supposed to say that your race, your color, your creed, your religion, where you come from, how you speak, what your language is, has no bearing on your ability to buy a house. And if someone treats you in any way unfair, they've broken these fair housing laws. They can be sued. The broker has to treat you fairly and objectively, and they cannot ask you certain questions. They can only find out if you can afford the house. It has nothing to do with where you came from or about you personally. So are there questions coming through, Maddie? So more estimates coming through. And more, okay, I see one. If you are a co-signer on another mortgage, how much of that is calculated in your debt to income ratio? That's a great question. I think what they would probably do is they'd probably end up splitting the difference. They would probably dig for details about trying to find out how much of it is your responsibility. But you're exactly right. There's two things out there, by the way. There's what's called the mortgage, and then there's what's called the mortgage, and then the deed. So the mortgage is what people share or what you have in terms of payment on the house. The deed is what shows ownership of a house. So if you're talking about a mortgage, then the lender will quiz you and want to know how much you're committed to on that. That's how they would probably handle that. Okay, any other questions coming through? I'm not seeing those. Okay, I will go on. We have a few more minutes. So I've covered the what I call the protections. This is the roof. Just as the analogy goes, I've covered the foundation, the basic things you need to build this house up, the housing choices, which again, in my analogy here is really, what it looks like, where it is, all the choices you make. Again, lots of people to help you in this process. By all means, use them because they're there to help you. And the good news is the most important one, the broker is free. Once you begin to go down the pathway, though, of a purchase and sales, now you are starting to put more money in the game. Let's look at the final flow here. Now, this final flow I made up, which shows, again, I have to realize this is typical. So this is a typical flow. Please don't hold me to it. Just say this is a typical way for you to buy a house. So let's go from step 1 to step 12. On the left, number 1, budget and save. I would say to you, never stop that one. Keep budgeting and saving. Keep doing it, right? The more you save, the better. It's free, meaning you don't pay anyone. Number 2, review and repair your credit. Get the highest score you can get. Start paying, making sure that your debt ratios are low on your credit report. I don't say close cards, I say pay them down. Do not close cards. Take a first-time homebuyer course, number 3. That's what I mentioned. Look for them. The certificate, at least where I am, are good for 2 years. And you pay a relatively small amount to be able to, if you need to, get a mortgage in your area for a 3% down payment. If you're a veteran, you can get it for a 0% down payment. If you're taking out an FHA loan, they look for 3.5%. Let me tell you one strange thing, though, that I know about FHA loans. In most cases, we all talk about the 20% down payment. If you paid 5% down payment, you pay private mortgage insurance. The way it should work, and I emphasize the word should, is that when you get to the 20% equity mark, your bank should notify you, hey, Peter, good news, you've reached your 20% equity mark in your mortgage. You no longer have to pay us PMI, right? Because now you're a 20% equity stake. Number 1, not all banks remember that. Sometimes you've got to remind them. And number 2, if you do go and take a first-time homebuyer course, it allows you to get into houses much cheaper, meaning the down payment, but you do have a much higher day-to-day mortgage because you're paying for all that, interest and principal that you're paying as well as the PMI. So various things to consider. Let me go through a couple more and answer your questions. Pre-approval, that's where I talked about again that typically first you get you might get pre-qualification, which is unofficial. Pre-approval is when you apply to a bank to say, hey, can I get pre-approval? Yes, this is important to do early because it tells everybody in the whole world what you can afford. If you can't afford more than a $200,000 house, your real estate broker won't take you shopping in the $500,000 neighborhood. They will ask you, what are you pre-approved for? You contact a realtor. Again, some people say this comes before the pre-approval. You decide, but they are your key person. If you don't like them, walk away and find another. The clock starts ticking now. That typically, and this is the best case scenario, maybe in 2 months you can get this done as you start. Number 5, is the realtor. Number 6 is you find a home. So working with a realtor on what you can afford, you begin to say, hey, I like this house. My suggestion again to everybody is don't get your heart so emotionally tied up in the house. Be more objective. If you let it loose, and don't forget, I've heard of stories like this, by the way. If you're walking around the house looking at things with you and your husband or you and your wife or you and your partner, and you start chatting about how good this thing is or how bad this is, they often have little, like the microphones on like they do for their kids. They don't turn them off. Sometimes they even have hidden things where they hear you. You don't want to disclose anything about how much you love a house because then they'll never lower their price. Number 7, you make an offer. You put down the $1,000, and if they accept your offer, there's a whole timeline that starts of you must have it inspected within a certain period, usually a week. So you got to act on it. You can't go to sleep or go on vacation. Now the time clock has started. And if you miss some of these things, that you can lose your offer. You can lose your down payment if you don't pay attention. So you get the house inspected, you hear the story, the good, the bad, or the ugly, you make a decision. Do I go through this? This is where a good attorney will write contingencies will write a contingency that says something to the effect of, upon the receipt of a positive inspection, we will continue through with buying this house. You need a backdoor escape route because you don't want to commit all that money and then not be able to do it. So the question I see there is there a way to know how much you are pre-approved for without taking the hard hit in your credit? No, that's what I call pre-qualification. You can do pre-qualification of unofficially talking to somebody, but once you officially apply and they pull your credit, that's only one hard hit. You gotta pay the price, $200, $300, $400 for the ability to get your pre-approval from a bank. And then yes, they're going to pull your credit. There's no two ways about it. If your offer is accepted, you need to put down at least, again, typically 5%. It's going to differ based on the mortgage you got. It could be 2%, 3%, 5%, 0% if you're a veteran. But then once you put it down, it's all written in. Your attorney builds, number 9, the purchase and sales. Again, if it's your own attorney, you may pay extra, but if it's built into the overall closing cost, what you pay for them, they are important that they are good. They're a real estate attorney. You apply for a mortgage officially. So getting pre-approval on step 4 doesn't mean you have a mortgage. You apply for a mortgage after you know what the house is and it's appraised. Don't forget that they won't give you a mortgage for a house that's only worth $200,000 on its market value. They're not going to give you a $300,000 mortgage. They'll give you a mortgage related to the value of the house and what you can afford. So those things all come together. Okay. All right. So let me see. Okay, last couple things. We've got a few more minutes. You need to get an insurance binder. Again, this is not your house. You need to generally start that process of getting an insurance company to commit that they will insure the house. That's simple, that's quick. And then finally, last but not least, you go to the closing. The closing date is set by the lawyer. You have no choice. Do not miss it. Do your walkthrough on the day before or the day of the closing. That's your last chance to see it and make a decision about it. And all those things go together to help you. I'm going to end up here by my summary. And I know we're at the final minute here, but here's my final summary. And you'll get all this, by the way. Before buying a house, one should know if they're ready or not. With all that I've said today, if you don't know that you're not, if you don't know if you're ready, I would say don't do it. It's too big a commitment to go ahead and do it and then find that you can't afford it. Number two, build a strong financial foundation. It takes time and effort to build up your credit, to build up your savings. It takes time. So if you're just starting today, my suggestion is wait some more. I'm sorry. You never know how the market's going to go. Nobody knows if houses will go up or down. Nobody really knows. So just do the best you can on your own. Most important, finding and working with a trustworthy team. The key word here is trust. I don't care if you go through 14 brokers, find the one you're comfortable with, that you trust, that you believe in, and is knowledgeable. And once you find them, stick with them. And then ask their advice on the team. Don't go with a broker who says to you, I want you to go to this inspector, and you find out that the inspector is their brother-in-law. Or go to this person as a lawyer, and you find out that that's their cousin. That's not right. You want at least 3 recommendations, if not 5, for every person you're trying to fill in your team. So you make the decision, you do the research. Be realistic, honest, and flexible. If you really don't feel you're ready for this, and you don't have the house of your dreams, be open-minded about other choices. You may find one that's a fixer-upper and one that you can afford to get into. My suggestion once again is, if you really believe in that house and you can make it work, start small, get into the house, fix it up. 2 years, 3 years from now, sell it and start over again, but you've built up equity. Listen to your home inspector. If they tell you how serious something is, don't ignore it. Listen to them. They're telling you their advice. You paid for that. $600, $800, depends on the inspector. You got to manage the time and money and expectations for this whole process. Once you commit the $1,000, the clock starts. You better pay attention. Get everything in writing. Be ready to walk and ask lots and lots of questions until you're satisfied. I'd say to everybody on the line, thank you so much for being with me. We're right at the big hour of 5 o'clock. My email was out there, pmullen@Consumer Credit. If I have not answered your question, I will take your questions via email, and anything we've covered or not covered. I thank you all so much. The websites I have here are for you. They are great, great sites for you to check on more info, and I wish you all the best. So thank you all so much for being with me. And again, if I missed your question, please feel free to write me. Thank you all so much. Bye for now.